coming into the Asia market today, what's on top of investors' mind is actually geopolitics. The situation in the Middle East feeding into uncertainty about oil price. And the reason I say that is because if you look at the best performing asset class today or asset is actually the US dollar. The dollar has certainly spiked, and that's caused a more risk-off mood. But I think you're absolutely right in saying that in the backdrop, there are two other things that happen. One is the market has been repricing Fed rate cut expectation over the last couple of days, and that was certainly reinforced by strong data overnight in the US. And secondly, we had China activity data, and it was, I think, a beat relative to expectation, at least on a headline basis, which maybe have led some investors to think that there's less of a chance of more policy support, which the economy still needs.
China's quarterly GDP read shows the country is growing faster than expected. Can that data be believed, and why?
So I do think that the headline GDP number only tell you part of the story. I think that there are a couple of things I would highlight apart from the GDP number. One being that if you look at the momentum of activity, actually March was probably much weaker compared with January and February. So that shows the growth probably started off on a strong foot, but then weakened a little bit. And that's true across consumption, its production, as well as export data. The other thing I would highlight is that if you look at the growth drivers, it's very clear that economic growth is being driven by investment, but demand is quite weak, as we can see with retail sales data. So that is a very uneven recovery as well. So I think that given that, and of course, lastly, if we look at GDP, that's mostly a volume data. But what's happening at the same time is that profits are not growing as much, prices are falling. So there's a bit of disinflation, if not deflation pressure. So I think if you take these other three aspects, which are outside the GDP, headline GDP print, then the overall message is actually somewhat mixed.
Looking specifically at the GDP data, is China trying to export its way out of its economic slump?
I do think export is a very big growth driver. Historically, it's always been a strong growth driver. And now that we have these emerging industries like auto, like battery, it's clear that they're also looking to expand globally. And I do think that is still the path forward. Having said that, I think there's a consensus domestically that demand also needs to be boosted. But policymaker probably hasn't quite landed on the right mix of policy that can get domestic demand or household confidence going at this point.
When do you expect that domestic demand will indeed pick up?
Well, I think several things have to happen. The most important thing probably is that the housing sector needs to stabilize. I think that we haven't found the right policy mix to prevent further credit stress from happening, which it's really weighing on confidence for the household sector. So that definitely something more needs to be done.
Do you expect, even if economic growth does hit the target this year, that it will be more difficult to maintain next year, not least because of pushback from trading partners?
I think even second half of this year could be more of a question because clearly we've already seen the momentum of data as weaker in March compared with 2 months earlier in the year. And there are three other specific challenges that we still think need to be resolved in the second half. One is that the housing market hasn't stabilized, and that is a very big part of the economy and very big part of wealth, and as well as a big source of confidence. Second thing is, as you rightly mentioned, there's higher chances of trade friction in the coming months. So that's another possible headwind for the export sector in the second half. And thirdly, policies are simply too tight. If you look at where levels of real interest rates are, or even nominal interest rate, it's too high for most corporate sector. But the policymakers haven't necessarily eased as they needed to. So I think the lack of policy support is another reason why second half of this year looks more challenging.
Julia Wang, good to speak to you.
Thank you for having me.